Thanks, Jim, for being with us today at GAIM. Could you explain us a bit more about your role and how you see as well hedge funds fitting into the endowment model?
Sure, Sophie. I have the privilege of being the CIO of Wake Forest University in Winston-Salem, North Carolina. We're about a $1.5 billion pool, and our mission is pretty simple. It's to invest in the lives of our students. And part of that is a return, obviously, but part of that also is helping them find jobs when they graduate college, give them access to some of the brightest and best managers in the world. And hedge funds play a large role in that from the standpoint of they're about 55% of our total allocation, as well as a lot of our managers take interns from the university. We have 2 managers that have exclusive programs for Wake Forest students. So giving our students access to some of the most talented investors on the planet is a great advantage and something that we think is very important for the university.
Excellent. So you're also investing in hedge funds?
We are. We have about 55% of our portfolio. 55. And you go back to that concept of the endowment model.
Okay.
Made famous by David Swenson at Yale and carried forward with people like Scott Malpass at Notre Dame and Matt Wright at Vanderbilt. It's an important part of our model, and it comes down to we think that's where the talent is. And so we try to find the most talented managers on the planet, and our job primarily is to separate talent from luck. And we find a lot of that talent is in the hedge fund space today.
Okay, and you basically, what you've seen as well is hedge funds evolving. Can you explain us what you've seen, the recent evolution post-crisis?
The biggest shift post-crisis for us has been this paradigm shift from a transaction to a service, where they're really trying to provide a solution for us. The days when they would show up in our office and we call it show up and throw up, just tell us their story is over. They come and want to hear our story. What are our challenges? What are our risks? And that, I think, is a huge evolution. Trying to match our risks with that of our portfolio and that of our managers has been a huge advantage for us, and it allows us to do more than one thing with managers. And we have a concept that we took from Bill Ackerman, which is return on invested brain damage. It's a lot of work to hire a hedge fund today. It's background checks, it's going through the terms and structure, and that for small staff like us with 7 investment professionals takes a lot of work. So to find a manager we really believe in and have high conviction in, we want to do more than one thing with them. So it's something that we find has been a refreshing change for us, is to go away from signing dotted line into our fund and going into what can we do for you? How can we solve your problem?
All right, so they're more flexible in a way, just to adapt to the investment's needs.
More flexible, and at the end of the day, they're all entrepreneurs, right? Most of them own the business, so they want to make the business and grow, and they're seeing this as an opportunity.
Where do you find the pool of talents, basically? And are you invested in European managers, Asian managers, for example, or you concentrate really in the US?
We have managers all over the world. We have less than about 7% of our portfolio in US long equities.
Okay.
So we have more frontier markets, Africa, Europe. We don't have a whole lot in Asia right now. South America is a large focus for us as well. So we have built a portfolio that is nowhere near US-centric.
Okay. And how do you see the portfolio evolving these days, where it's more risky time, market is more volatile? Did you change a bit the allocation?
About 2 years ago, after the crisis, we started really focusing on credit as a big part of our portfolio.
Okay.
And that's not U.S. Treasuries, that's high yield, it's bank debt, leveraged loans, and that's been a great place to be recently. We spent a lot of time in the last few months on macro strategies. Obviously, European distress is something everyone's talking about, and here in Monaco, I hope to meet with some of those managers this week. The other area that we look at very closely right now is equity. And long-term equity seems to be a place that we're under-allocated to. We'll spend some more time here and focus on that next couple of weeks.
Okay. So you see, here there's been a lot of discussion about whether hedge funds still make sense in a portfolio. And what strikes me really is this difference between the US, where you still see a big commitment to invest and look for talented managers, search for returns, where in Europe, with all this also legal and regulatory constraints, investors are, I think, pulling back a bit of investment. So When I probably talked to European investors and said it's 55% of the portfolio is hedge funds, they were like, oh my god, it's more in the region of 5 to 10%. So it's interesting to see that you're building that culture. You're going direct, or do you use funds of funds, for example, or what's your approach?
Primarily we go direct. We do have a fund of fund in both our private equity portfolio and our hedge fund portfolio for 4 reasons: diversification, access, transparency, and knowledge transfer. Again, with 7 people on our staff, it's very hard for us to go to Europe and spend 5 weeks in Europe, in Asia, be on the ground in Singapore and Kuala Lumpur. So we try to find use those managers to fill those holes for us. But it's rare that we have a manager we can't get into. So for the most established managers, we can do that directly. And also, we're doing a lot of work now. We're a day one investor. And
that's interesting.
One of the advantages of being an endowment is we have a long time horizon. So we want to be looking for managers that are at that $100 million, $50 million, they're going to go to 500, go to 700. We're rarely investing in the $24 billion manager going to 25 billion.
Here's some US investors mention about 8% returns in targets. Are you there, lower? Have you lowered your expectations? Where are you?
We haven't, and historically our hedge fund portfolio, even last year, did much better than that. And with lower volatility. So one of our unique factors at Wake Forest is we have a risk factor approach. So we don't have a hedge fund asset class. There's not a bucket for hedge funds or large cap value or small cap value or growth or bonds. So we have exposure to risks like duration and spread and momentum and liquidity, and that allows us to take advantage of much more flexibility around the structure. And again, goes back to the talent is in the hedge fund space because they get paid better. That's what we're going to try to focus on.
Great. Well, thanks a lot again for sharing all this insight.
Sophie, thank you.
Very interesting way to invest in hedge funds. Thank you.
Thank you.